Hey YouTube, welcome back to my financial focus. In this video, I'm going to talk about the short straddle options trading strategy. I'm going to talk about how to open it in Robinhood, how to experience the max profit, the max loss, what happens if we get assigned at expiration, the break-even prices, how we profit before expiration, and then also how to close the strategy before expiration. So everything to do with the short straddle. So thanks in advance for leaving a like, and let's get right into it. So the way we open up a short straddle in Robinhood is just by selling a call option and a put option at the same strike price with the same expiration date. So in this case, I'm just going to sell a put option at the 125 strike, and then I'm going to sell a call option also at the 125 strike, and that's going to give us our short straddle position. And basically we can see right here that the max profit potential for this strategy is just the credit of the call option and the put option added together. Because remember, when we sell options, we're collecting the premium as a credit. And so in this case, the credit of the call option is $1,043, and then the credit of the put option is $1,240. Add those together, we get $2,283. And so that would be our max profit, would be the credit that we would collect. And as soon as we sell this strategy, as soon as we open up, this total credit is going to get deposited into our account. And then obviously as the strategy goes on until expiration date, we have potential to lose this credit depending on the movement of the underlying. And that brings me on to my next point, which is how we would lose money with the strategy, our max loss. And the way we would lose money is if the share price of the underlying moves significantly in either direction. That's how we would incur our loss. And we can see right here that the max loss is actually unlimited, and that's because of our short call position. Theoretically, the share price of the underlying, in this case Alibaba, could increase infinitely. It could increase all the way to $1,000 per share. And so if that were to happen, we would be forced to buy 100 shares of Alibaba at the current share price, whatever it was, if it was $1,000 at that point on expiration date at April 14th. And if we did do that, we would buy it at 1,000 and then immediately sell it to the call option owner at the strike price of 125. And so considering that the underlying share price can increase indefinitely, that means that our max loss is unlimited because it's a short position, similar to a short stock position. And so I touched on it a little bit just now, but I'm going to go into more detail now about what's going to happen if we get assigned at expiration. And so as I just touched on, if the short call is in the money, then the trader is going to be assigned negative 100 shares of stock. And so if they already own 100 shares of stock, then they're just going to be forced to sell their 100 shares of stock at whatever the strike price is for their call option. And if they do not own 100 shares of stock, then that means that upon expiration date, if the short call is in the money, they are going to be forced to buy 100 shares of stock at whatever the share price is on expiration date, and then they will immediately be forced to sell it back to the call option owner at the strike price of the call option. And then vice versa, if the short put expires in the money, that means that we, as the shorters, I don't know if shorters is a word, but as the traders who are shorting the put, we will be the counterparty to the person who owns the put. I remember, if somebody owns a put, that gives them the right but not the obligation to sell 100 shares of stock at that strike price. And so if someone owned the 125 strike put option, that would give them the right but not the obligation to sell 100 shares of stock at the 125 strike. And so theoretically, for them to profit, they would buy 100 shares of Alibaba at $121 per share, and then they would exercise their put option and they would immediately sell them at 125. And since we are the ones who short the put option in this particular case, we would be the ones who would be buying their $125 strike price shares. They would be selling their shares to us at $125 per share. But since the share price is obviously $121, as soon as we buy the shares from them at $125 per share, we would immediately be incurring a loss of about $3.80 per share. And so now, leading into that fact, I'm going to be talking about the break-even prices. And this is probably the most important part of the short straddle because it demonstrates how we are able to profit even if the share price on expiration date is not right on the strike price of our options, which is obviously a very unlikely scenario for on April 14th, the share price to be exactly $125, which would be how we would collect our total credit. But to keep things short, the break-even prices are basically calculated by taking the strike price of the call or the put, in this case, is the same strike price for either option, and then just subtracting the amount of premium we received or adding the amount of premium we received to the strike price. So in this case, the strike price is 125. If we multiply that by 100, that gives us 12,500. That would be our position if we bought 100 shares of Alibaba. It would be $12,500. And so we do $12,500 minus $2,283, and that would be right here. So at $102.17 per share, that is what the share price could theoretically drop to, where we would still break even. Because if we buy 100 shares of Alibaba at $125 per share, and then on expiration date, the price of Alibaba is $102.17 per share, we would break even because we collected $2,283 when we opened up this strategy, and $125 per share for 100 shares minus $102.17 per share for 100 shares comes out to $2,283. And so that would be where we would break even there. And then also vice versa, the break-even price for the call option, in this case, the short call, is $147.83. And that's because, obviously, we collected the $2,283 premium, the credit, when we opened up the strategy. And so if on expiration date the share price is at $147.83, we will be incurring a loss of $2,283 because we bought 100 shares at $147.83 and then immediately sold them at $125 per share. So we would lose $2,283 on that transaction, but because we collected $2,283 when we opened up the short straddle, we would just break even right there. So long as on expiration date, the share price is between 147.83 and 102.17, we can experience a profit. It won't be our total profit, but it'll be a profit nonetheless. And so the last thing that I'm going to talk about, which is also very, very important, is how the Greeks interact with the short straddle position. Primarily how Theta Decay interacts with the short straddle position, which I'm sure many people watching this video have come to the same conclusion by now, which would be correct. Basically, whenever we're shorting an option, the value that the premium loses as a result of Theta Decay is actually value that we collect as the people who went short on these options contracts. So typically when somebody goes long on options contracts, like the video I made 3 days ago about a long straddle position, when they buy an options contract, the Theta Decay is value that they lose because Theta basically points out how much the options premium will decrease every single day. So right here, the put option is worth $1,240. So with each passing day, everything else remaining equal, this premium will decrease by $7. So it would be, 7 cents here. So $12.40, and it would decrease by 7 cents with each day. So tomorrow, this is going to be worth $12.33 or 32 cents, give or take, right? But obviously, since we're the ones who went short on these options, the value that the people who went long on it collect, or the value that the people who went long on it lose, is the value that the people who went short on it collect. So since we went short, with each passing day, we will collect 7 cents. And that's how we can profit from this strategy before expiration date. just as long as the share price is staying right next to the strike price of the options, the value that these contracts lose in the way of extrinsic value, that's value that we will collect, and we'll start to collect it faster and faster as the expiration date gets closer and closer. Also, right here we can see implied volatility, Vega. The short straddle has a negative implied volatility interaction because implied volatility increases the premium of options contracts. And as the people who went short on these options, our goal is for these options contracts to lose value. And so if the implied volatility increases, that means that the options premiums will increase, which is bad for the trader who owns the short straddle. It's great for the trader who owns the long straddle, but in our case, in this video, if we're the owners of the short straddle, that is not a good thing. We want the implied volatility to decrease because that will decrease the premiums, and that will be value that we collect and profit from. And lastly, I'm going to talk about how we can close a short straddle before expiration date, whether it be at a profit, maybe we experienced a lot of profit and we want to close our strategy early, or if there's a loss, like if there's a significant price movement and we want to close our position before we experience any more losses. The way we do that is pretty simple. We just do the opposite transaction of what we did to open up the short straddle. So in this case, in order to open up this strategy, all we did was we went short on the put and the call. So in order to close this position, we would just buy the put and buy the call, and that would close our position at whatever the current price of the position is. So if when we go to close it, the position is worth, I guess, if it decreased in value, so if these premiums decrease in value and we close it, then we'll obviously close it for a profit because some of the credit that we collected we'll get to keep, and then obviously we'll pay credit back in order to close the position. But if there was a significant price movement and the position increased in value, then obviously if we're buying it back at a more expensive price than what we collected when we sold it, then we'll obviously be incurring a loss in that particular case. So that was everything to do with the short straddle. Let me know if anyone has any questions in the comments section below. Definitely subscribe to the channel for more content like this. Leave a like on the video, and I'll see everybody in the next one.